Hi guys, I'm Ryan Mack and welcome back to another episode of The Trading Guys. And today I'm going to be running through the differences between a static stop loss and a dynamic stop loss. I'm going to be running through all these various points here and how you know when to close off portions of a trade which is going against you, and how you know when to scale in and add positions to a trade which is going in your favor. So the key to trading is you want to keep your losses as small as possible. You can't avoid having losses in trading. But the key is you want to keep your losses as small as possible. And when you're onto a winner, you want to try and take advantage of that and get more from it, okay? We are also going to be covering different things that you might see, especially if you're on my PAM account. For example, maybe you have $1,000 or $5,000 or $10,000 linked to my PAM account. And one day you might go on and you might see that there's a trade there. And when you look, you've profited $1.26. And you'll be thinking to yourself, why the hell would Ryan cut a trade if I'm only in profit $1.26? Well, it's not. There's many things for that. That could have been a losing trade. So when I see it coming down, instead of being at a loss, I've just cut the trade, and then if I had let it run, maybe your account would have been down $200, you know? So when it's up £1.36, you know, $1.36, you think, why would they trade that? The reason behind it could be that we entered the trade, it started to move in our way, and then very quickly pulled back and started going against us. So I have to make the instant decision to cut that trade while we're ahead, or even at a small loss, you know? It could also be that you may have quite a few winners, so up $36, up $50, up $12, and so on. And then the last one will be, you know, up 56 cents. And you think, why is the last one only 56 cents? Well, what would have happened in that occasion, probably, is that the trade ran in our favour. I would have closed 80% of the trade to get in the bulk of the money that we had already gained. And then from there, I would have moved the stop loss to break even. And then as it's kept running, I've then moved the stop loss to a trailing stop where it trails. So you're in profit. So it's came back, hit the stop loss, which has closed your account in at a mild profit, a slight profit. And that's why these things occur. So we're going to cover, we're going to cover that today. We are also going to cover how do you know if it is just a pullback and then it's going to run your way, or how do you know if it's a pullback and it's going to keep continuing against you? We're going to cover that. I'm going to cover when to cut a trade and when to scale into a trade. So don't go anywhere. So in this lesson, a static stop loss versus a dynamic stop loss. So here's the difference. Let's say, as part of your trading plan, you always know before you enter a trade how much that you're willing to risk in that trade. So for example, some people are 1%, some people are 0.5%, some people are 2%, some people are 5 and 10%, depending on the experience and the style of trading. So this is the difference. Let's just take this example that me personally, I'm willing to lose 2% per trade. 2% is what I sacrifice to lose per trade. Now, I always cut my losses early, so I don't think, even up until today, I've ever lost a full 2% in a losing trade because I always cut my losses early. But let's just say we've entered the trade and we're now willing to lose 2%. So let's say for the size of my account, 2% is the monetary equivalent of 3 lots, right? So if I enter a trade immediately on 3 lots, that means I'm immediately risking the full 2% that I'm willing to risk on that. And what happens is, as the trade, you know, let's just say it was a sell order. So as the trade, you know, comes down, as it starts to come down, we then close positions as it's coming down. All right, I'll make them a bit bigger. We then close positions as it's coming down, and your stop loss is obviously going to be up here. If this comes down and starts to pull back up, you would then start cutting half of your trade. As it comes up, you would then start cutting off half, closing half, so that by the time it hits your stop loss here, you haven't lost 2%. Maybe you've lost 1.20% because you've started cutting off your trade early, okay? It's just good risk management. So if you enter a static risk and you've entered immediately, on your full 2%, right? And the trade starts going in your favour, so it starts coming down. When it comes down to here, I usually close around 50 to 80% of the trade in this first one. As it comes back up, I wait to see if it's going to come back down, and you can then scale in at this point, okay? But sorry, I'm digressing here. Your static is if you enter on your 2% right away and it's coming down, and that's essentially it. You're not gonna really scale into this. Why? Because you've already risked your 2% from the very beginning, so you wouldn't normally scale into this. Maybe if you're a more advanced trader, then you would scale in. You would scale in here, this area here, and you would scale in again this area here. But that'll come on in a different video because that's a little bit more advanced. So dynamic stop loss, a dynamic trade is, hold on. So if you're going to do a dynamic stop loss, right, your total that you're willing to lose is 2%, which in this example is 3 lots, okay? 2% of your account, 3 lots. Now, on a dynamic, you do not enter the trade on 3 lots right away. What you do is you break this down into smaller bite-sized chunks. So if I was trading 3 lots and I was going to start using a dynamic risk, what I would do is I would break this 3 lots down into 6 chunks. So you've got 0.50 lots per trade. Now this is really good because what happens is when you are looking for a trade, let's just say, right? Let's just say the market's coming up, it's topped out, it's done a bit of this, it's topping out again, and it's going to come down. You want to see confirmation that is going to come down and not just come here and fly off again, right? You want to see confirmation. But sometimes what can happen is you could have got in here, but you haven't really had the confirmation that it's going to pass this level yet. So you're sitting there waiting for it. And what happens is you get the first candle, which is here, and you think, right, that could be seen as a bit of an engulfing candle. Potentially the second candle could be a dark cloud cover, and that would maybe be your confirmation to then get in on the third candle. But especially if you trade things like GJ, what can happen is, and you've probably noticed it yourself, is by the time you get to the second candle goes like this, bang, and flies. And then the third candle maybe comes up and then flies again. But you think to yourself, oh, I've missed the trade, because by the time that this flies down, if you enter the trade round about here, you stand a massive chance of, let's say you enter the trade here, right? You stand a massive chance of the market coming back up for a pullback, hitting out your stop loss, and then tanking. And I bet you there's people watching this right now that think, oh, that happens to me all the time. Yeah, that's the reason why. So, if you are up in this region here, right? And you've already entered, let's say, if you'll be too worried at this point to enter on your full 3 lots because you still haven't seen the confirmation. And if you enter here, you have a massive risk that it's going to pull back against you and fly up for a pullback, you know, or a fake out before it then goes short. In which case, if it hits your stop loss, you're going to be down about $500 or $600 in one go. You know, with 20 pips, you got a 20 pip stop. You're already gone. You're wiped out. So people that trade static are going to be waiting for confirmation here. But this is the power of trading dynamic stop loss. If you break it down, you can break it down into 1 lot, 1 lot, 1 lot if you wish. I prefer to break it down into half a lot, 6 times, as opposed to breaking it down to 1 lot 3 times. It's just my preference. You can do whatever you want. So by doing the dynamic stop loss and breaking it down, this allows me, when I see this first candle, I can take the risk and get in. I can say, bugger it, I'm going to get in right here at half a lot, 0.5 lots. I'm going to get in here at half a lot because if this comes back and stops me out and I'm wrong, well, it doesn't matter. I mean, the account's going to be down 0.10%, which is peanuts. You're not even going to notice it. It'll be like a couple of quid on your account. But if it goes in my favour, that means I'm already in, and you can make some really good profit on that. If that runs 40, 50 pips on half a lot, you're probably going to be up $250, you know, on that size of account. So that's a pretty good trade. And then what happens is, when it comes down, when it breaks past this previous support line, you can then scale in again another 0.50 lots. Oh, sorry, half a lot. okay? 0.50 lots. As it comes down, and it goes like this for a pullback, you can then close 50% of your position or 80% of your position, right? Close partials, it's called. And as this pulls back here, you've already closed partials, right? At this region here, you've closed partial accounts, so you've already banked money. Your stop loss, which would have been here, is no longer here. You've now moved your stop loss to what's called break even. So you've moved your stop loss to the areas where you've entered. So if this pulls back all the way up and goes past here, you've already secured your position, so you've already made money. And if it stops you out, you haven't lost any money. So it's essentially what we call a risk-free trade. It's a free trade, okay? Because it's now risk-free at this point. However, if it just gives you the standard pullback, which it always does, especially on GJ, and then comes back round, you then re-enter here another 0.5 lots. So you see where I'm going with this, and you enter in again, and as it passes here, and it confirms it's going to keep going, you would then enter here another 0.50 lots. And at any given time, if this comes down, if you entered this last one, right, for example, and it immediately comes down and goes bang and hits this stop loss out, well, it doesn't matter, you're only down a couple of quid. But overall, you've already gained from 1.5 lots, and you've already banked your positions. And these ones, even though this is pulled back, because you managed to get in so early and you didn't have to wait for this confirmation away down here, which many others teach you to do, you've already profited massively. This is still in profit, even though it's pulled back. And at this point, when it gets to such a level here, you can move these stop losses, which are currently at break even, you can move them down to in profit. You can move them down to here, so that now, if this pulls back and hits your top stop losses, it's actually stopped you out and you're still in profit, okay? With that one, with moving your stop loss into in profit as opposed to break even, you have to be a little bit cautious, because this is what it does. If you're on a run, I'll make this fresher again, right? Let's say you're on a run, okay? Let's say this here is your break even point. What the market does sometimes is it'll give you a pullback, and it'll give you a pullback right up. So if it pulls back here, it's gonna miss stopping you out at break even, right? But if I'll rub this out, if this is coming all the way down, right, and you've moved your stop loss to in profit, which is down here, you don't want to be right on it, of course, but let's say you've moved your stop loss to take profit, which is right here. What you'll find the market usually does is he'll pull back, he'll hit your stop loss, and then he'll tank again. So because you've moved your stop loss to take profit, he's going to stop you out, and then he's going to continue his massive run. And don't chase it. If you do get stopped out, do not chase it and think, oh, I'm going to get back in. Just leave it. Just, all right, I'm done. And just wait until the next day, or find a different pair or whatever. Don't overtrade. But you can see here, if you had just simply kept your stop loss at break even, you've still given yourself a chance to ride the wave. Now, there's a risk to reward and everything. You are risking being stopped out. You're risking that this could come back up and stop you out at break even. But if you've already closed 50% or 80% of your position, you've already made money, so it doesn't matter. But if you want to make more money, then you have to think, right, should I just close it out here, or should I just let it run? You know, these are the things that you have to go through as a trader. It's not pleasant, but there's no avoiding it, you know. You have to be in it to win it. You can't make money without risking money in trading, I'm afraid, and that's just the way it goes. So let's see what else we've got here. Right, closing off percentages, or sometimes known as scaling out. I'm going to cover that now, 2 seconds. Okay, so now we're going to come on to closing partials, securing profits, right, which I think is very important. You get some people that, let's just do this again. You get some people that, you know, they'll enter a trade, let's just say it's here. The stop loss will be up here, and the take profit will be down here, for example, all right? And you'll find that they'll enter a trade and be like, yeah, who cares? If it hits my stop loss, it hits my stop loss. And that's fine, but it's not, you're not maximizing your risk management at all. Why would you be happy with losing 2% when actually all you have to do is sit at the screen, monitor the trade. If it comes against you and comes past here, close half of your position. So then let's just say it's going to hit your stop loss, right? Let's just say if it hits your stop loss, you're going to be down $600, okay? But if you manage this and this comes up above here, if this comes to here, right? You've entered here, this comes to this top part here, the last resistance. If that gets to there, your account might be down $75, right, at that point. So you just hit close half your position. Because why would you close half and not full? Because it could just be coming for a retest, and then after here, it's going to absolutely melt and tank, you know? So if you close out half your position when you're only minus $75, then you're only going to be down $30 odd, you know? So, and then if you get stopped out fully, instead of being down $600, you're probably going to be down $150 all in. So that's a massive difference, right? If you just let it hit your stop loss, you're down $600, or you manage the trade, and even though it's coming down, close half, so you're down $33, whatever it is. And then if it keeps running and hits you can close half. As this passes and goes higher, you can hit close half again, close half again. So at the end of it, you can be down in total $85 to $100, as opposed to just letting it run, hit your stop loss, and you're down $600. That over time, with all of your losing trades combined with your winning trades and scaling in, is going to make the world of a difference to you. I can't tell you how powerful it is. So yeah, just don't be lazy and practice it, you know. It's very key. It's very important to manage your trades, not just get in and you know, hope for the best. You have to manage them. So what you normally find if you've been in trading for a while is that the first kind of 2-3 candles will give you the biggest moves. Now, there's a reason for that. The reason why the market maker makes this fly away is because when this comes up here, there are people that they've been told when it breaks the top here to get in for a buy order going up, right? And that's part of their strategy. But sometimes the market maker pulls it just slightly above so that people get in the buys. And as soon as they get in the buys, a buy order going up, that means that their stop losses are down here, right? They're down in this region here. So what the market maker does is, as soon as he has induced enough people to place buy orders, he quickly whips the market away in the next 2-3 candles to wipe out all of their stop losses. And it's quite a big move. So I usually try and enter around about here, right? If I get the candle confirmation, which I'm going to cover that in a different video, okay? But if I get the candle confirmation here, the candle pattern that I'm looking for, that I take an entry on, and I enter here, what I do is, as soon as these first 2-3 candles give me that big massive movement, it could be instantly, especially on GJ, 25 to 50, 60 pips in one move. Well, sorry, 3 candles it will be. So what I do is, I then immediately close 80% of my trade. I have a thing called magic keys, which I'll show you. In fact, it's on another video. And you can hit custom close. And I made my settings to, when I hit custom close, it closes 80% of that trade, right? So when I get to here, I close 80% of the trade and I move my stop loss, which would be here. I move my stop loss to here, which is break even. And then as this pulls up and comes back down, I then re-enter here. When this gets to here, I close 80% of this trade, not all trades, just 80% of this trade, and I move the stop loss to break even. My previous stop loss would have been up here. And then as it goes down, I just repeat that process until I get to the end of the trade, and then I'll just close it all out. When you start to see the candle pattern where it's going to start coming back up, and then I just probably close out the trade around here once I get the confirmation of that. It's very, very powerful. Now, when you close 80% and you leave 20% as a runner, you're not going to get every single 20% runner that's going to run. You're just not going to get it. Sometimes this can come down, right? You've got your 20% here, you've closed your 80%, your stops are at break even, and then this just about turns and it just carries on going long. That can absolutely happen. And that is the power of closing off 80% of your trade and letting 20% run. If this comes back and stops you out, it stopped you out at break even, so you haven't lost any money, number one, and you've already closed 80% of your trade, so you're already up money, you're already in profit, okay? Very, very important. Yeah, I've already covered. Yeah, so if you're on my PAM account and there's some trades in there and you look and maybe one of the trades is up, 26 cents, you'll be thinking to yourself, why is it up 26 cents? Well, remember, when I trade the PAM account, whatever amount is there gets split between everyone who's in the managed account in a percentage ratio according to how much funds they have in the PAM account, okay? So that's just, when you see that, it's more often a case of one of two things. It's either a trade that started going against me, against us. So instead of me waiting to be at a loss, I've just closed it and it's happened to close a very small amount in profit because it was in profit. Then it's pulled back, and as it's pulled back, I've thought, yeah, I'm getting out of this trade. I've closed it, and then it's ended up with a small profit. Of course, I'm not going to close a winning trade at such a small profit, so that's the reason why. It could then also be that I have simply already taken the trade, so your previous wins, you'll see that there's more money, let's say $30 odd, $100 odd, whatever, depending on the size of your account. And I've moved the stop loss to break even. So when I move the stop loss to break even, I move it slightly down, just a couple of dollars, because I incorporate the spread. Sometimes if you move break even and you don't incorporate the spread, when it hits your stop loss, instead of being at zero, break even, you've actually lost a couple of quid, and it's because of the spread. So when I get to break even, I always drag it a couple of pips down to cover the spread fee, and that's why. Okay, so that's the two reasons for that. When to cut a trade short and when to scale in. Well, we've already covered scaling in, all right? And to cut a trade short, you really want to see it coming back past the previous high. If it comes past the previous high as a full, you want to start closing 50% right away here. You don't want to let that keep running. And then if it keeps going, you can just hit close all, or you can keep hitting close 50, close 50, close 50, close 50, because that makes your percentage loss even smaller again than what it would be by just simply closing out. All right, so that is when you would close. But remember, the best confirmations, the strongest confirmations are in the higher time frames, the 30-minute, the 1 hour, the 4 hour, etc. Well, I always use the 30-minute and the 1 hour. I don't really use the 4 hour. The 15-minute is for your entry. If you're a day trader, you look for the best entry. The 5-minute is your best entry point as a scalper, if you're a scalp trader. But once I enter a trade on the 15-minute, I then go straight back to manage the trade on the 30-minute and the 1 hour, because what you'll find is on the 15-minute, you get a lot of this jumping around, and then you start to feel the anxiety when you're trading because the market's just going everywhere so fast. But if you jump across to the 30-minute or the 1 hour, when you've got candles coming down and candles coming up, in the 15-minute, it doesn't happen in the 30-minute or the 1 hour. You notice that the candles just go like this and come down, and it's much better for that feeling of anxiety that you get when you trade. And here's one more thing. Here's a thing when it comes to managing risk. I know I've done another video on managing risk, but some people have asked me in my DMs, how do I know if my risk is too much? Even though I've used the calculator, I'm willing to lose 2%, but when I get in a trade, I'm still like, the minute I get in a trade, I'm panicking, I'm worried. If you're panicking and you're worried when you enter a trade, it means that your risk is still too high. So you don't have to go with 2%, remember. Go with 0.5% until you build your confidence up. It's perfectly fine. The way to look at it is you should be able to place a trade, turn your computer off and go to sleep. And that means that your risk is absolutely fine. If you cannot place a trade, turn your computer off and go to your bed and have a good night's sleep, your risk is far too high. If you're just sitting there thinking about, checking your phone every 2 seconds, is it running? Is it running? Yeah, your risk is far too high. Even if it is just 1% or 2%, still means it's too high for maybe your confidence or your trading ability. You just haven't been trading for a long enough time yet to get used to it, okay? So that's really it. I'm going to be covering 2 more videos, which we'll run on after this. Thanks very much for watching. If you would like to practice and learn, we've got tons more videos teaching you how to place trades, how to manage your risk for absolutely free. If you would like if you would like for me to send you those videos, please get in touch with us at The Trading Guys. Any social media, The Trading Guys on Facebook, Instagram, Snapchat, and you can also visit us on www.thetradingguys.com. and you'll see everything that we offer there. We have a full members area and so on. And you can even set up a demo account with us for up to $100,000, and you can play around with the demo account until you've gradually built up your confidence to the point where you think that you'd be able to trade live money on your own. Or you can then join our setups and signals. I don't like to say signals because people have this kind of stigma around signals, but we have a setups and signals group where we actually show you the setup. Okay, if GJ gets to this point and gives us a double top and rejects, we're going to enter the trade here. So it's not just a signal. We teach you what we're looking for and how we trade, how we enter and when we exit. And obviously, whenever we place those exact same trades ourselves, we give you those trades so that you can take them yourself and you're actually trading in line with us. So I know some signal providers send a signal and the guy isn't even trading himself. He's just sending you out things and hoping for the best. It's not how we work. We have over 40 odd members now and they're all doing extremely well. So yeah, don't forget to join us at The Trading Guys. I'm Ryan Mack and join us for the next episode coming up. Thanks a lot for watching.